Hey everyone, welcome back to episode 71 of the What Do We Do podcast. On today's show, I'm joined by the lead portfolio manager of the Van Eck Digital Assets Alpha Fund, Mr. Pranav Kanaday. And we're talking all things crypto, from FTX to NFTs to making money in tokens in 2023. It's going to be a great show, so let's go.
Welcome to What Do We Do? A podcast discussing wealth management and financial planning featuring key leaders in our communities. Hosted by founder and CEO of Great Lakes Wealth, Dewey Stephan. Tune in to hear how you can plan for and live your best life.
Well, welcome back to another episode of the What Do We Do podcast. I'm your host, Dewey Stephan, and today's episode is another guest episode where we bring a leader in the community onto the show who has a story to tell, knowledge to share, and advice to give. And then we bring them on the podcast to help our entire community invest for success. And with all that is going on right now in the digital assets and crypto space, Pranav Kanaday is with us. He is the portfolio manager for the Van Eck Digital Asset Alpha Strategy. Pranav, thanks for being here.
Of course, excited to do this.
Heck yeah. This is unbelievably crazy. What is going on with the FTX debacle?
Well, there's a lot to unpack there. Maybe as a starting point, looking at the founder, Sam Bankman-Fried, he had a pretty big role in the broader crypto ecosystem. On the one hand, he'd built this phenomenal exchange where market makers and customers would come and trade. He originally started in the space as being more of a prop hedge fund firm with Alameda Research, but he eventually built this great exchange that, at some point they had over, I think, 12, 13% of the market share. And he'd also built up a big presence in DC, and he was kind of moving the needle or pushing sort of rolling the snowball down to get regulation done so that there's black and white rules and there was more clarity on the broader space. So he was doing a lot of, good on the surface, if you want to think about it that way. He was a big figure as a result in the space. But unfortunately, what it looks like is it turns out that he might have been doing some potentially questionable things. We're all speculating here on what happened and how it all went down, so I don't want to put labels out there. But essentially, what seems like happened was a certain large number of customer deposits kind of went poof and disappeared. Typically, when you're on an exchange, let's just say you're using Coinbase, and you put in $100 and buy $100 worth of Bitcoin, they're supposed to hold an equivalent amount of Bitcoin on their balance sheet. So if you want to redeem or sell and take your money back, there should be one-to-one matching. In this FTX case, it seems like they did not have the one-to-one balance matching, and so the big question is, where did it all go? And we could all kind of speculate on where it all went. One version of it is that there was some of it, or a lot of it, that went to the hedge fund that he was running back in the day that was theoretically supposed to be separate, but in this case, it might have been one and the same, and they were using customer deposits to do maybe all kinds of speculative things, and that disappeared at some point. And now the depositors on the exchange are kind of left holding the bag.
Okay, well, we're going to dive into that even more. But for those out there in YouTube land, Podcast Nation, I want to thank you for tuning in to the What Do We Do podcast. We have over 50,000 downloads of the podcast. We also have over 1.5 million total social media views. And as we always say, we're just getting started. Listen, Van Eck is a money management firm located here, and this is where we are today. For those of you that are paying really close attention, this is not our normal set. We are actually recording from the Van Eck headquarters in Manhattan, and Van Eck is an asset management firm that's been around since 1955. And they started with a expertise in gold and a belief in gold as a hedge against the dollar and other types of, other types of investments and whatnot. Well, now in the world of digital gold, and that would be Bitcoin, but the space of digital assets, we're talking about the here and now. And whether that's FTX or just in general, this is an entire ecosystem. For those out there listening and those out there watching, check out season 1, we did an overview of blockchain and cryptocurrency. And in season 2, Pranav would love this, we did a podcast on Bitcoin, Ethereum, and Dogecoin, these things called meme coins. Okay, we're not really going to get into those today, but for our listeners and our viewers, we really want to explore the space. It is insanely volatile. It is insanely crazy. There are NFTs, there are CBDCs, there are over 19,000 tokens.
Yep.
These are also known as coins for those out there in the listening audience. So with that, let's kind of get into it. What are your thoughts of the space in general now, and as it relates to FTX and this unbelievable event that's happened? Some say it's just the tip of the iceberg. Some say there's more to come. You run a fund here at VanEck that probably has some sensitivity to this on an investor level. So why don't we talk about what else the fallout may be?
Yeah. One of the things we are constantly thinking about is who are these customers that had their assets at FTX now and cannot get their assets back. And if I were to break up that composition, it was probably other funds, hedge funds, venture funds, probably customers. So I think 80% or more of FTX's trading volume seemed to be coming from retail, so a lot of individuals, and that's just my guess. And a large percentage is also market makers who are providing liquidity on these platforms. So when all these set of people and institutions essentially lose such a large amount of money overnight, the question to ask is, have those institutions and people borrowed money from somewhere else to be able to do what they're doing? So that's the big question we're all asking. So one of the things we saw last week was one of the lenders within the crypto space called BlockFi stopped withdrawals, customer withdrawals. And that's likely because they had a bunch of their customers' assets sitting on FTX, and they might have also even lent money to people who had assets on FTX. And so they can't meet withdrawals from their own customers. So that was kind of the first one we saw. The question is, who else are left with sort of obligations to people who had money stuck at FTX? That's the contagion we're kind of looking to see. Now, the thing about crypto in general compared to the traditional markets is these unwinds happen a lot faster and quicker. So, you don't theoretically have to wait months and years to figure out where the contagion is. It, should theoretically happen in the next couple of weeks and months. So from our standpoint, we're just waiting and seeing who says what next.
So from your standpoint, the assets that you have in a wallet or at a custodian, a crypto custodian, that's all you really need to be concerned about is if they'll be solvent, right? And if the investments that you put there will stay there. Obviously, with this fallout, the price of many of the tokens has dropped. That's, I guess, to be expected. And so you would have to manage through that as a portfolio manager. But in terms of, again, securing or understanding that the assets that have been given to you, the dollars that you then invested into the crypto and digital asset space, is that the primary concern? Is to make sure, I don't know, if it's at Coinbase, that it's going to be at Coinbase, or if it's on a different ledger, it's going to stay there. What are the main concerns there?
So I think our approach to this has always been, let's rely on the core technology. The core premise of blockchain-based technologies is to give the user self-custody. Right, which is don't rely on someone, don't take credit risk to someone, self-custody. Now, this could be financial assets like tokens and crypto assets, or it could be even your identity assets in the future, right? So right now, I imagine if you're on Instagram, Mark Zuckerberg custodies your identity assets. So the whole vision for blockchain and crypto is the user should have authority and control of all their assets. So our approach here at VanEck has been, at least in our strategy, that we will use a self-custody technology where we shard our keys, and so we control our private keys. So we don't leave assets all the time on exchanges. We only go to the exchanges to execute our trades, and then we bring our assets back. That's a safe way to do it. That's the crypto way to do things.
Okay. So what happened with all these other investors? And there were some high-profile names that might have some of their assets held there. So were they naive? Were they caught up with the hype, or were they co-investing? And what do you think happened there? And then we're just going to talk to what do you think is going to happen with the next level of fallout.
Yeah. Well, I think, as you can see from the FTX cap table or set of investors they pulled together, it's kind of like your blue chip, best of the best, right? So, the question is why, what did they see here that they wanted to invest? Well, on the one hand, they saw really fast growth, and that seemed like a good litmus test for what the product FTX had built. And anyone that was an avid FTX user loved the product as well. So they'd built something that was truly useful and valuable for people within the ecosystem. And Sam, as a founder, is pretty charismatic, and he went out and got commercials with Tom Brady and labeled stadiums and did the whole thing to bring new members into the crypto space. So you put all those things together, and it almost seems like for someone who doesn't fully understand blockchain and crypto, it seems like a good proxy way to get exposure to the space. A builder who's building something interesting and useful, and that's showing real metrics and growth. So I could see how other people thought of this as a potentially good investment at the time. Now, with I don't want to call it fraud, but with these types of situations, it's very hard to predict. 2020 hindsight is one thing. So I think I understand why they might have made that choice.
Pranav, they say that when you see a cockroach, there are many other cockroaches behind the wall that you do not see. Yeah. So in this space, and some are likening it to 2000 to 2002 with just a traditional tech. Yeah. Back then, or 2008 with the financial crisis. So do you see any similarities just from a historical perspective, and or again, are there other shoes to drop? There's another cliche out there. There are going to be other issues that it's just going to take, a week or two, a month or two to find their way through the system, other bankruptcies, et cetera.
Yeah. I think over the weekend, there was another crypto exchange that people were a little concerned about. One of the things all the other exchanges did as a result of what happened with FTX was they disclosed wallet addresses of all their assets. So they called this proof of reserves. They wanted to show the market, like, hey, look, here are our wallets and here are all the assets. Now, what we don't know is, like, what are the liabilities against those assets, right? So if an exchange says, hey, I have $20 billion worth of assets, the question is, well, how much customer liabilities do you have against it? So we still need to find that out. But as all these other exchanges started to sort of disclose their wallets, crypto Twitter went crazy and did all kinds of forensic analysis with these wallets. And, one of the exchanges had some unusual behavior where they were sending hundreds of millions of dollars of Ethereum to other exchanges, getting it back. And so, you saw some panic on this other exchange because nobody wants to hold on to the next FTX type situation, right? So there's a lot of nervousness in the market, which is resulting in people withdrawing assets and taking self-custody or, exiting altogether. So in these types of sort of shock events, you would think that all the bad apples come out and they'll kind of flush the system, and hopefully we can rebuild on a better foundation from there.
Fantastic. And time will tell. And there are those that say this is the opportunity of a lifetime to get in. They still believe in it. It could be Cathie Wood. It could be other novice investors out there that say Bitcoin will go to 100,000 a coin, US dollars. 250,000, et cetera, et cetera. So we're not going to get that grandiose and that crazy with valuations and expectations today. But some say, again, with these prices, and whether that's on Bitcoin or Ethereum or any of these other 19,000 coins, tokens that are out there. But in general, there are those others that say this is just the beginning. This is it. This is what we saw. This is the worthless pieces of paper. How do you defend that argument that this is just the unwind of something that's never been worth anything ever anyway? And then where are these opportunities? We'll get into those too.
Yep. I think I go back to the core premise. What is this technology about, right? To me, it's about allowing peer-to-peer interactions without middlemen in sort of intermediating and taking a piece of the pie. So, decent example is if you look at payments today. If I spend $100 on Walmart.com, Walmart only sees $97.50 of that transaction. So the $2.50 goes to the facilitator, like a Stripe or a Square, goes to the Visa, MasterCard, goes to the merchant acquiring bank, most likely J.P. Morgan, Bank of America, one of those guys, and then goes to the merchant acquirers themselves, like Fiserv or a First Data, one of those guys, right? So that there's 2.5% of every transaction is eaten up by these middlemen. Now, those transactions could ultimately settle on blockchains, right? So it could settle on Ethereum. Stripe's been experimenting with this. They made some interesting announcements on this topic in the last 6 months and even last week, where Stripe will make it such that, so Stripe's the facilitator of all e-commerce transactions on most websites. So if Stripe can start allowing merchants like Walmart to accept stablecoins, like a USDC, then you could eliminate as much as 2% of that 2.5% of cost. So all of a sudden, Walmart can start seeing, $99.50 on a $100 transaction. Now extrapolate that across all e-commerce businesses, all brick and mortar businesses. If you can get these transactions to settle on blockchain rails, there's a big cost savings to the ecosystem. So the question one is like, how do you get the consumer, like you and I, to spend USDC rather than use our credit cards? Now the onus there is on the players like an Airbnb or like a Walmart to figure out how to make it user friendly for you, because there's money to be saved for them. So that's one interesting area of peer to peer, where you can get rid of a lot of the middlemen by settling it on a public ledger, a blockchain.
So in the traditional investment world, not specific to what you just said, but it used to be there was a bid and an ask for stocks, and there still is, but back then it might be a $1 spread between stocks, because there had to be two people that were walking on the floor of the stock exchange and transacting, so they had to make a profit in between, right? Well, now with technology, there's still a bid and an ask, but it's sometimes a tenth of a penny, sometimes it's half of a tenth of a penny. So again, over time, technology has made it a better transaction for the customer, and so that obviously makes a lot of sense. And so what we're going to do today, Pranav, is we're going to focus on the reality that digital assets are here, and that you as a portfolio manager believe in the space, and you believe that this is either a new frontier or we're in the first inning of a 9-inning ball game. I'll let you kind of maybe tell us that in baseball terms. Where are we? Maybe we're still in Little League and haven't got into the pros yet. But with that, we'll go kind of fast, because our audience is younger, they're vibrant, they want to know, like, let's just get to it. Where are investment opportunities now? What should we stay away from because of what we saw today? Maybe we short the whole market for the next 30 days. I don't even know, can you short those investments to a degree? So let's just talk through the whole spectrum of let's make some money in this space.
So to be honest with you, I'm not going to give any investment advice at all. That would be irresponsible on my part. But I can kind of give some mental models and frameworks to think about this stuff, right? So crypto assets, digital assets today is less than 50 basis points of all financial assets. So that's how small this market is today. The idea, again, is a big idea, which is everything in the world we have today is some form of a marketplace. It's allowing human beings to come together to do some kind of commerce. And so those middlemen always take a fee. So if you can get rid of the middlemen, then these blockchain systems will thrive. So that 50 basis points of what it is of the financial markets will be a much, much larger number if the vision comes together. If you were to put a probability on it, I would think it's probably 35-40% this all really works. But if it works, the upside is massive. Again, 50 basis points of all financial assets. So the question to ask is, what needs to happen for the probability to go from 35-40% to a much larger number? And to me, those are two things. One is blockchains need to be faster and cheaper. Ethereum is scaling right now. There's layer 2s that are coming onto Ethereum that will make it faster and cheaper for the end users. And the other one is it has to be a lot more user-friendly. So the whole premise around peer-to-peer is you custody your assets, you custody your private keys. And for that to happen, that needs to be user-friendly. Like, the average individual resets their email password pretty frequently, right? So that means they're constantly losing their password. Now imagine losing the password to all your financial assets and that goes poof and disappears. That's the risk. So that needs to be made a lot more user-friendly and simple. And there are a few people working on those solutions and making that whole thing work. So from our perspective, we look at those things as the bottleneck. So we're primarily investing in things that solve those bottlenecks, because the idea is if these bottlenecks are solved, the probability of success goes up, and as a result, these assets that we're investing in will hopefully generate a meaningful return because they're solving a big problem that exists in the space.
So is that coins and tokens, or is that, again, parts of the blockchain or traditional technology and semiconductors for speed and power, or where in this ecosystem is it?
So primarily everything we do are in the token space, because most of the projects we're investing in are networks, and the value accrual asset in networks are tokens, right? Ethereum doesn't have a stock next to it, right? In peer-to-peer networks, the cash flow being earned by the networks is now accruing to the token. So tokens are just another form of a capital formation instrument. So we're primarily investing in tokens, but we also could invest in companies directly if companies are making some of these things achieve some progress. But yeah, most of the value will be in tokens in our view.
Okay. And then again, it's kind of common sense that the granddaddy of them all is Bitcoin.
Yeah.
Right? That's the first token. And then there are the secondary and other tokens behind it. And then there's all the way down, the food chain, I guess. And it sounds like that within all the tokens that are out there are some specifics with different ones. And it sounds like there are some that are, for today versus for tomorrow, or the utility of them is all over the place too. So besides the bottleneck, what are some themes that are out there that you're looking towards, or, some themes that you're staying away from?
Yeah. So one of the things we say as a part of our strategy is we want to invest at the intersection of three primary characteristics, which is Metcalfe's law and network effects, where every user coming on board to use a project adds exponential value to these networks. Projects that can get to 100 million daily active users. So most blockchain-based projects today have about 3 million daily active users. Facebook is in the billions as a comparison point. So that's point number two. Last point is tokens that have cash flow-based value accrual. So if more people come use this thing, that pay money to use this thing, how does that money then flow to the token itself, right? Kind of like if someone buys a bunch of Apple iPhones, how did that value flow to Apple stock? Well, there's a share buyback in place. That's how it flows back, right? So similarly, if a bunch of people come and use this product that is getting a lot of users, how does that go to the token? Well, it has to be some cash flow-based way. So we're investing at projects that meet at the intersection of all three of those things. So what we've said is we think there are 4 categories in crypto that are primarily interesting among the many categories that exist. Those are consensus layer, which is the underlying blockchain, application-specific projects. So this is another term for proof of physical work, where people like us are helping build networks by doing something physical in the world. Happy to give you some examples there. There's some really interesting ones. And then decentralized infrastructure. So things like, decentralized storage or decentralized indexing, like just useful picks and shovels that allow this to happen. And lastly, some regulated centralized exchanges are also pretty interesting.
Okay. And then where would, some random words in the space for our listeners and our viewers let's talk about DeFi, let's talk about NFTs, and let's talk about, I guess let's start with those two, and then Web3 / blockchain. So just some buzzwords in the space. Can you give some comments on those?
Right. So blockchains are just kind of these ledgers that allow, in Bitcoin's case, there is no programming language on top. It's not Turing complete, so you can't code on top of it. But Ethereum is a blockchain that allows you to build applications on top, right? So the way I think about Ethereum simplistically is like it's Amazon Web Services meets Apple App Store. Those two things combined. Because Apple App Store has apps. Those apps are usually using computational services from Amazon Web Services. So that's kind of what these blockchains are. Web3 is an all-encompassing term for this change in computation. So historically, computation has happened in Web 2, or Web 2 computations happened in these, essentially siloed monopolistic companies. And the idea of let's use blockchains that are for the public and build applications on top. That's kind of the Web3 movement, is what I would call it. DeFi is one category that's built on top of public blockchains. So it's trying to disrupt the banks, right? So on DeFi protocols, I can primarily exchange assets with other people in the world without an intermediary. So right now, if I want to trade some stocks, I have to go to TD Ameritrade, and there's a whole bunch of intermediaries that allow me to sort of do that. In the blockchain world, I can go to a decentralized exchange like a Uniswap, where I can swap assets with other people that are also in that ecosystem without a middleman.
That's Uniswap, not SushiSwap.
Correct.
Have you heard of that one?
Yeah, SushiSwap is like a copy or fork of Uniswap in some ways.
Right on. All right, 2 more in that space. One would be staking, talking about staking your coins.
You asked me about NFTs. So the NFT thing is kind of interesting. NFTs are just, to us, a file format. So tokens in general are fungible, right? My 1 Ethereum is the same as your 1 Ethereum that you have. Non-fungible just means that my asset that sits on a ledger is unique. So what it would really, the big idea then is like, okay, so we could actually ascribe uniqueness to digital assets across the board, and the use cases become pretty interesting from there, right? So everyone wants to talk about the monkey pictures, but like the monkey pictures is kind of silly. Like that's just like a silly manifestation of this technology. What's more interesting is using sort of NFT technology to establish identity for people on the blockchain itself, and using some form of that to eliminate the spam problem that exists on the internet, right? Like Twitter's biggest problem are fake bots. Well, you can eliminate fake bots if you can verify identity. Well, how do you make sure that you can verify someone's identity without you custodying their identity information? Well, that's where sort of these blockchain-based technologies come in. That's where I think NFT use cases can become interesting. Because if your identity can be an NFT that you custody yourself and you share certain parts of it to show an app you're using that you are not a bot or a fake person, then that solves a lot of the internet's problems. So NFTs today, what you think of is very different from where it's all going, in my view.
So
Yeah.
absolutely, as you said, with the monkey pictures, but again, other digital pictures. So that just kind of seems to be the investment that's there. Let's create a digital picture.
Right.
It could be of monkeys, or it could be of houses or whatever. And because it's an original,
Right.
that has some value, and you can trade these and sell them. So it that's what you're saying is not where the true value is in the technology. Is that right?
Yeah, exactly.
Okay.
Yeah.
Okay, fair enough. Well, we're going to switch to a part of the show, Pranav, that we call the What Do We Do podcast turns into the What Pranav Do podcast, okay? So this is the part of the show where we say what Pranav do, and what we mean by that is what would you tell your 18-year-old self or other 18-year-olds out there today that are so excited and so wanting to invest in digital assets, cryptocurrencies, NFTs, the blockchain, this entire space. It's all over the place, meme coins, etc. So what would you tell yourself if you're 18, or again, the massive amount of listeners out there that are 18, we can have them invest for success?
Yep. I think from an educational perspective, I would say learn computer science, learn how to code, and learn history and economics, because those three things are the most useful thing, like just knowledge or foundational knowledge you could have in this space, because that's where like crypto meets, right? Economics, history, and computer science and just coding. But more just day to day, get yourself a MetaMask wallet, hopefully convince your parents to give you a little bit of money, and just start playing around with stuff, right? It's just all a toy at the end of the day. And the more you kind of use it, the more you'll intuitively understand, and you'll ultimately understand why it's a better way of doing things than the way we do things today. And that's kind of the light bulb moment for me, when I started playing around with different applications built on the blockchain, 2017, 2018. So even though it was like a crappy user experience, you could then see where it's all going, but also then track the progress the space was making. And so when there are breakthroughs that happen in the space, you can benchmark it against where it was a year ago and see where it's all going. And that's how you get a feel for it.
Fantastic. That makes a lot of sense. So all of you listeners, all of you viewers, please pay very special attention. Words from the wise. I'd like to wrap up the show by having you just give us a little bit of what you see the future being. And again, if you want to go on record and tell us what the U.S. dollar price will be for any of these tokens, that would be fantastic. If you want to just, again, talk about the long-term places to invest within this ecosystem, that would be okay. But let's go. Let's see what we can do to, again, give our audience, a little bit of the meat and potatoes and a little sizzle with the steak.
Not going to give price targets, unfortunately. I'm sorry about that. I think crypto assets today is around 700, 800 billion. If the technology were to work and gain meaningful adoption, I could see it being in the tens of trillions in the future. So you can kind of put the multiplier on that, right? Now the question is who wins, who loses? There's 19,000 tokens out there. That number is growing exponentially. We think ultimately there'll be like 50 to 100 projects that really accrue all that value, right? So if you go to the Apple App Store, there's 2.5 million apps, but most of the GDP of the Apple App Store kind of sits within 50 apps, right? Like Uber and DoorDash are way more valuable than the bottom, 500,000 apps altogether. So that's how we think the space will evolve. So, which areas to focus on? How do you think about that? I just go back to the very basics, which is, does this product have the potential to make human life a lot better in the future? Does that, ultimately I kind of boil things down to the best products in the world save people time. So you want to invest in products that really save people time. Now, one could be it saves people money and hence saves people time over, decades. But in general, products are supposed to save people time. So, so find those things within the crypto space that ultimately can do that.
Okay. Well, we'll leave it there for today. Hopefully we'll get a chance to have you come out to Detroit on our turf, and we'll talk more in detail about digital asset investing and all things in the space. Pranav, it was great having you on today. I want to give a great big booyah to you. Thanks again for coming on. It's been fantastic. And to our listeners, our watchers, our viewers, our audience, thank you for tuning in for another episode of the What Do We Do podcast. And as we always say, live your best life. Be radically generous. A great big booyah to ya. We are over 1.5 million total social media views, and we're just getting started.
The opinions expressed in this program are for general information purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It's only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risks and possible loss of principal capital. Please seek advice from a licensed professional.